You are an exceptional mind top of your class at a leading university. You step into the grand lobby of a dazzling skyscraper, the headquarters of a hedge fund on Wall Street in 2026. You press the elevator button thinking you are stepping onto a typical administrative career ladder. Something like work hard, do your job well, and seniority will come with time. A very naive assumption in this industry. The moment the steel elevator doors close, you realize you have just entered a completely different environment. This is not an elevator that ascends gradually. It is a gradient, a brutal survival arena. Power is extremely concentrated, and it is defined by a single metric: profit. To put it bluntly, you generate profit, you have power. Today, you will move from the first floor to the very top of this tower through 7 levels of power, not just to see how much money you make, but to understand how decision-making mechanisms evolve, how risk becomes distorted, and what the true cost of power really is. This is a brutal journey. Starting from the ground floor. Level 1. Analyst. At this level, you are the intellectual engine of the fund. You work around 60 to 70 hours per week. Your salary ranges from $100,000 to $150,000 US plus discretionary bonuses. Sounds decent. But your decision-making power, 0. You cannot independently allocate even a single dollar of the fund's capital. In return, you are protected. You do not bear direct risk if the portfolio loses money. Your only pressure is the risk of losing your job if you are slow or not efficient enough. But efficiency in the 2025 to 2026 period has been completely redefined. AI has replaced approximately 55% of basic modeling tasks and traditional data collection. Tasks that once took 40 hours a week are now handled in minutes. If you imagine a hedge fund as a fine dining restaurant, then at this level, you are like a prep cook, chopping vegetables, preparing ingredients. And then suddenly the owner brings in an AI system that can do all of that with absolute precision, thousands of times faster. The question now is no longer how hard you work. It is what value do you still have in the system. So, to survive and rise to level 2, senior analyst, you can no longer compete by trying to chop vegetables faster than the machine. That is impossible. Instead, you must create a recipe that the machine has never learned. Because when AI can prepare data perfectly, every time the competitive edge no longer lies in processing information. It lies in variance perception, the ability to see a differentiated perspective. Your task at level 2 is to look at the same dataset that AI has already analyzed and identify a blind spot that both the machine and the crowd have missed. When you rise to senior analyst, where income can reach $300,000 to $600,000 US, you must prove that your formula actually generates value. And the benchmark is extremely harsh. You must produce at least 3 investment ideas that directly contribute to the fund's profit. Specifically, each idea needs to generate more than 10 basis points. That is 10 basis points, 10 basis points on total assets under management. At this point, your ideas begin to be translated into real cash flow. But even so, you still do not hold power. You are still just the one who proposes strategies. You present ideas and hope that the portfolio manager will allocate capital to execute them. You are still standing outside the game. So how do you move from standing on the sidelines, pointing, to directly controlling hundreds of millions of dollars to place bets? That is when you cross an important boundary. Level 3. Portfolio Manager PM. This is the most significant turning point in your entire career, where the definition of risk changes completely. You are no longer facing execution risk. You are facing the risk of owning P&L. At level 3, you are assigned a portfolio typically around 300 million US dollars. And your income at this stage is tightly bound to a cold mathematical formula. You receive 10% to 20% of the net profit you generate. At first glance, it sounds like a dream millions of dollars per year. But in reality, it is more like a pressure cooker, especially within the structure of modern pod shop funds, such as Millennium Management or Citadel, the organizations dominating the industry in 2026. In this model, each pod, a small investment team, operates almost entirely independently, and the key lies in one mechanism: pass-through cost structure. Simply put, external investors pay for the entire operating cost of the pod you manage. Everything, from computer systems, Bloomberg terminals, satellite data, to your own salary and the salaries of your analysts. And when investors fund all the costs, they demand something close to absolute capital preservation. That is the reason drawdown limits exist. And this is not a gentle warning. It is an automatic kill switch. If your portfolio loses around 5%, your trading system can be shut down immediately. Your pod is closed. Assets are liquidated. And you lose your job on the same day. No explanation required, no second chances. At level 3, the reward is enormous. But mistakes are terminal. It is so ruthless that your P&L is measured on a daily basis. You can be at the peak of glory on Wednesday and be fired by Friday simply because a macro movement went against your prediction. The line between survival and collapse is razor thin. But suppose you survive that furnace, you move up to level 4 senior portfolio manager. At this stage, the capital you manage exceeds the 1 billion USD threshold. Your income can surge to 2 to 3 million US dollars per year. You begin to build and lead a team consisting of analysts and even junior PMs beneath you. It sounds like you have reached the top, but in reality, your risk is greater. At this level, you are no longer just facing the risk of picking the wrong stock. You are facing the risk of managing people, and most dangerous of all, overconfidence. You may think you have proven your capability, you are controlling over 1 billion US dollars, you have an excellent team filtering data for you, so why is the pressure still so high? Because there is no such thing as a safe zone. That very strong team creates a deadly blind spot. At level 3, the fear is very primitive. If you are wrong, you are wiped out. That life or death pressure keeps you extremely disciplined. But when you move to level 4, a streak of past success begins to create an illusion you are invincible. Natural feedback loops gradually disappear. You are no longer micro-monitored every day. You begin to loosen risk principles. Or worse, you stop listening to dissenting opinions from your own team. You unconsciously surround yourself with people who only say yes. And you forget the micro-level factors that once made you successful. The difference here is, in this industry, the price you pay is not a bad business quarter. It is the complete destruction of a legacy. It only takes one senior PM letting ego override discipline. Not only can a billion-dollar portfolio be wiped out, but the entire team behind you collapses with it. The market does not care how many employees you have. It only cares, are you right or wrong? And then you begin to realize something if at level 3 and 4 you are maximizing profit within your own pod. Then who is looking at the entire system? If you are the one placing bets at the table, then who owns the casino? The answer lies at higher levels. Level 5. Partner. The prerequisite here is skin in the game. You are no longer just managing other people's money. You must put your own money into the game. You are required to invest a significant portion of your personal wealth into the fund. There is no longer any separation between job and risk. Your income typically starts from 4 million US dollars and above. But more importantly, it is no longer dependent on a single portfolio. It is tied to the performance of the entire system. At this level, you no longer think like a player. You begin to think like a part of the operating structure of the casino. But the key point at level 5 lies in two mechanisms: global terms and escrow. This is perhaps the clearest illustration of the brutality of power. Imagine this: if you are the CEO of a technology company, when the company is profitable, you receive millions in bonuses. If the following year the company incurs losses, at worst you receive no bonus or you are fired. But the money you received from the previous year still safe in your account. At level 5 of a hedge fund, the rules are completely different. The fund can retain up to 25% of your bonus in an escrow account. If in the following years the fund suffers significant losses, the global clause is triggered. And at that point, the fund has the right to claw back the very bonuses you earned in the past. In many cases, you may even have to repay in cash after taxes have already been paid. This is not just a financial mechanism. It is a mechanism that enforces long-term thinking. It forces you to care about the survival of the fund over multi-year cycles, rather than maximizing short-term profit and walking away. Right above you is Level 6, Chief Investment Officer, CIO. This is where power no longer lies in individual investment decisions, but in the architecture of the entire system. You are no longer the one picking stocks. You become an air traffic controller, an air traffic control tower. Imagine this: portfolio managers are pilots, each flying an aircraft loaded with investor capital. And you are not in the cockpit. You sit in front of a silent radar screen. Your task is to see risks that no single pilot can detect. Take the 2025 to 2026 context as an example. The industry's average return is around 11.2%. But active equity strategies can reach up to 17.1%. The temptation is enormous. And what is the risk here? It is that all pilots want to fly into the same favorable wind. This phenomenon is called crowding congestion. When you place it in the context of the AI era, the risk becomes even more dangerous: hidden correlation. Suppose you have 5 extremely skilled PMs operating independently, but all of them are using AI models trained on similar datasets. These models independently arrive at the same conclusion, and all of them allocate capital into the same group of assets, for example, AI infrastructure stocks. At the micro level, each PM is doing the right thing. But at the system level, you are concentrating all risk into a single point. If that bubble bursts, all the aircraft will collide, and that is precisely when your role becomes critical. You must break hidden correlations. You must reroute capital flows. You must allocate assets in a way that resists catastrophe, even if that goes against what is working well in the short term. At level 6, you do not maximize profit. You control the survival of the system. Compared to simply hiring more talented PMs, you begin to realize something: systemic risk management is the highest priority. You are not just managing billions of dollars. You are cutting through invisible bubbles, things that others cannot even see. If at level 6 you are like the guardian of an airport's airspace, then at the highest level the threat no longer comes from within. It comes from the outside, and it can wipe out the entire system. You step up. Level 7 Founder. This is the absolute peak of the power hierarchy. And it is also where the greatest paradox in finance exists. In theory, your income potential is unlimited. But in terms of actual cash flow, you are the last one in line. Before you can pocket a single dollar of profit, you must cover the entire operating cost of the system, pay salaries and bonuses to all PMs and analysts, offset losses from pods that have been shut down. You are carrying an enormous existential pressure on your shoulders. And that pressure does not come only from the balance sheet. In the legal landscape of 2026, there are invisible nooses tightening around your position. One of them is key person clauses. If you, the founder, encounter health issues, legal trouble, or simply step away, institutional investors have the right to withdraw all capital immediately. There is no buffer. At the same time, the rise of SMA, separately managed accounts, now accounting for around 25% of preference among large investors, forces you to operate under absolute transparency. Every decision, every risk is placed under a microscope. And then you have to ask yourself, what does all of this mean? Especially if you are not working in finance, the answer is this. 7-level structure is not just about hedge funds. It exposes a core principle of power in any organization. Power and protection always move in opposite directions. At the lowest level, you have the least power. But you are the most protected by the system. You do not bear existential consequences. The higher you climb, the greater your autonomy. But the thinner the safety net beneath you becomes. When you are an analyst, the system protects you from market volatility. But when you are a founder, your own body reputation and entire personal wealth become the final shield protecting the system. True advancement is not measured by how many people work under you. It is measured by your capacity to absorb risk. It is a continuous transition from fearing job loss to fearing financial loss, to fearing reputational damage, and ultimately fearing the loss of a legacy. At this point, the concept of skin in the game is no longer purely financial. It becomes a philosophy of absolute accountability.